Good afternoon. Hope everybody's having a fantastic week. I'm Randy Sadler. I'll be your host for today's webinar. I'm a principal at CIC Services. We are a captive manager. And our webinar today is pertinent for many reasons, which we'll cover, but it's the 60-day countdown, which we do every year, basically, typically October, November, the significance of the countdown, and then who are ideal candidates for a captive insurance company or who should consider owning their own insurance company. So as we go through, I'll remind you, keep your computer or phone muted unless you've got a question. Otherwise, and we will pause for questions throughout as well. You can also type your questions in the chat, which I will be happy to field as well. These are some standard disclosures that we share, and if you request the slides, you will get these as well. But the disclosures are essentially pertaining to if you or your client decides to own their own insurance company. There will be many independent experts that will work with them on their behalf and on behalf of their insurance company, including independent attorney for formation and for policy drafting, independent actuary, independent tax audit work by their CPA. So that's all important background if somebody decides to own their own insurance company. And here's my bio. I'm Randy Sadler. As I mentioned, I've been at CIC Services 10 years. I learned risk management in the Army. I grew up in Tennessee, went to West Point. In New York, was a tank commander 5 years, and really learned risk management where I was overseeing soldiers, vehicles, ammunition, fuel, very dangerous work that required tremendous safety focus. And so safety was job one. And training soldiers to be safe, and then implementing a wide range of protocols for safety. So that's really where I learned risk management, was in the Army, and have tracked through corporations, including Procter & Gamble and Pfizer, and then some middle market companies. And now I'm here at CIC Services, where I've been here 10 years. So I'm excited to be your host today for today's webinar. So a little bit about CIC Services, just so you know who is on the call. CIC Services is a captive manager. We help businesses self-insure by owning their own insurance company. We've been doing that since 2005. It's a powerful way for a business to protect itself and really the livelihood of their employees, quite frankly, very important. And so we help businesses own their own insurance company, and that provides a lot of benefits. Establishing asset-protected loss reserves, increasing profit and wealth for the business and business owners, generally about millions of dollars over time. Definitely lowering or controlling their insurance costs. And one thing I always like to add here, very often it also includes having control over claims and claims handling, where a commercial insurance carrier might decide to fight a claim they should settle and then raise the client's rates. And then on the flip side, settle a claim they should fight and then turn right around and jack up rates again. So some of our clients really hate being at the mercy of commercial insurers, and you can see why. Insuring uninsured, underinsured risks. COVID-19 is a classic, which we'll cover a little bit. But these are typically the risks that actually put you out of business. It's not things you normally insure commercially. It's other risks that we'll explore. And then benefiting from insurance company tax treatment. So it's worth noting that if an insurance company is run correctly and qualifies as an insurance company for federal income tax purposes, and certainly any business owner needs to also run this by their tax advisor, CPA, then there is a benefit of being taxed as an insurance company versus being taxed as an operating entity. So that's what we help clients do at CIC Services. And a little bit more about us, it's worth noting, we do stand up for our clients and the industry. Many of you may or may not know, but then in 2016, the IRS issued a notice called 2016-66. In many ways, appears intended to harass business owners that are trying to protect their business and employees by requiring additional filings. And these additional much of the information they asked for is on an insurance company tax return that the captives were submitting already, but put it in a different order with penalties. And so we did in fact sue the IRS in 2017. The case made its way to the Supreme Court, where we won by a margin of 9-0. So we're very pleased with that. And you can read about it here. So as I mentioned, At the end of the webinar, you can ask for the slides. I'll send them to you, and there's a link right there to go to the article. So definitely worth reading. We also, continuing to stand up for our clients and our industry, then took the case after the Supreme Court to a U.S. District Court, who gave us an injunction against the IRS and their unlawful notice. And now the case will be heard on its full merits. You can read about that here, this link. But again, we'll continue to battle on behalf of our clients, on behalf of the industry, against what we see as an abuse of power by the IRS. And obviously the Supreme Court saw it that way too. So today's webinar, we're going to answer 3 questions. 1, what is a captive insurance company? 2, what is the significance of the 60-day countdown? And 3, who is a good candidate to own a captive insurance company? So let's take them one by one. What is a captive insurance company? Well, a captive is a real insurance company. It'd be sort of like if you went and bought State Farm. It would do all the things State Farm does. It would issue policies, it would pay claims, receive premiums, set up loss reserves. The big difference would be that State Farm is rated and admitted, meaning that all states have basically decided they have enough reserves, have done scrutiny, and let them write insurance to the general public. Your captive insurance company, at least at first, won't be rated or admitted. And so you're not able to write insurance to the general public, but don't despair. Certainly as you can write insurance for your business or related entities. And you can also potentially grow and eventually do write insurance for the general public. Many may know that Allstate actually started out as a captive for Sears and grew into a full-blown insurance company insuring the general public. So really, you never know when you get into the insurance business what's possible. What do captives do? So we talked about what they are. Well, captives can replace commercial insurance. They can insure enterprise risks. They can insure warranties. This is often found money. They can insure or issue performance bonds, and we've done bonding in construction. We've done bonding in coal mines. You can do bonding in a lot of areas. Subcontractor default, for example. They can also insure employee benefits or healthcare. And so this is a great way that a captive can help control costs as well. And we do have many of our clients in programs with a captive that is lowering their health insurance spend significantly. And the nice thing that I add at the bottom, and this is really pertinent to middle market companies, is they can do any combination of the above. So very often large corporations may own a few captives and segregate these things because they're so large. For a smaller mid-sized company, it's often more effective to run it all through the same captive. And the reason is quite simple. An insurance company has a fixed cost to run it. So the more things that you put through, the more you spread that fixed cost. So that's one way that middle market businesses are often different from large corporations. And the captive really has sort of this simple structure here where we have a shareholder or business owner or owners, their business or businesses, which they own dotted line and they get profit from, hopefully. And their captive insurance company, which they also own. They pay premiums and transfer risk to their insurance company. It issues insurance policies back. Now, the transactions are usually more complicated than this, but this is a captive in its simple form. And if you are an advisor to business owners, a trusted advisor, be it a CPA, be it a property casualty insurance agent, be it a wealth manager, be it a part-time CFO, advising a business owner, a captive can create really a separate profit center. Think about it as excess retained earnings, for example, but it creates a profit center and it can create assets under management. Many of the advisors we work with also manage assets, and they do like managing the assets in a captive. So this can be a very powerful win-win for your clients and for you. All right, very good. So consider, as we think about a captive, that our own government encourages small, mid-sized businesses to prepare for a wide range of threats. This is from ready.gov from 2015. It's their chart, not mine, but you'll notice on here a wide range of threats businesses face that they're encouraged to be ready for. That includes mitigation, but in many cases it can include insurance as well. And you can just look at this page and imagine if you got a commercial insurance policy for all of these, your business would go broke. And very few businesses can afford to purchase all this commercial insurance. However, many businesses decide to insure some of these risks in the commercial market and some of these risks in an insurance company that they own, which makes a tremendous amount of sense. And so here are some commonly, uninsured risks. The businesses often don't insure commercially. It could be litigation, supply chain, which is, wow, is that in the news these days, right? Receivables, for example, and not getting paid. Cyber is a huge risk that many businesses face, and many commercial cyber policies really don't cover that much. So if you have a loss, there's a good chance that you're not even covered anyway. You just think you are. How about a government agency coming in, auditing you and fining you, for example? Very difficult to insure in the commercial market, but many of our captives have insurance for government intrusion into their business. How about reputation? This is a huge one. It cost Target a fortune when they had their cyber attack, and so reputation damage can be extremely expensive to deal with. So you can insure reputation damage in your captive insurance company. And of course, we're still in the pandemic. Many businesses were closed due to COVID, and this is a massively underinsured risk. Why so? Well, most businesses that had business interruption insurance probably did not realize that their insurance would only trigger if their property was damaged. And so when they were closed by the government, or when their clients didn't come to their business, or when they were deemed non-essential, or when the events that they had planned were canceled, they lost a ton of revenue. Many businesses were shuttered, no surprise. And the point really is simply that they weren't ready for the pandemic. Their business interruption policies only worked if their property was damaged. So that's really what happened. Now I'll talk about coronavirus and captives here in a few slides, but our clients had a very different outcome. So here are commonly uninsured, underinsured risks. I covered some of these already, but here's kind of an exhaustive chart of many of the areas that a business can and should be prepared for, and that they can insure in their own insurance company. So another thing that I mentioned, and this is important, is the taxation of insurance companies, right? So large insurance companies, or traditional captives, are taxed like a large insurance company, like an Allstate or a State Farm. They receive premiums, they set aside loss reserves, they invest and grow that money, and then they pay claims. The part that's not reserved for losses is taxed as income, but you can see just the tax advantages that large insurance companies have of being able to invest money that they have not been taxed on yet. Very powerful. And this is why, if you drive into most major cities, the largest buildings in any skyline are the football stadium, banks, and insurance companies, right? However, small insurance companies, and this was created in 1986 by the Tax Reform Act of 1986, can actually benefit in the way that large insurance companies do, with a little bit of a wrinkle. So a small insurance company can actually elect to be taxed under Code Section 831B, provided they qualify as an insurance company for federal income tax purposes. And that allows them to be taxed at a rate of 0% on their underwriting profit if the premiums received are 2.3 million or less on an annual basis. So that's quite powerful. And investment earnings are normally taxed at ordinary rates, or that would be an ordinary C Corp rate, since insurance companies must be taxed as C corporations. But this section of the Internal Revenue Code helps small, mid-sized businesses build up the loss reserves that they need. And so that's one of the reasons that you see here. Let's call this a tale of two businesses, similar to the tale of two cities, the best of times, the worst of times. The business on the left, over a 10-year period, has some standard commercial insurance policies. And then they have $1 million a year of profit that they can allocate, and they basically pay their taxes and allocate that to savings. And so you see that over a 10-year period, they build up $5.9 million, and they have this set of insurance policies in place. The business on the right, however, really makes a different choice. They take $1 million of their profit and they allocate it to protect their business. So this is a strategic allocation of profit to protect the company. And they buy all the additional insurance protection you see here at the bottom. So they're picking up administrative actions with a government entity coming in and fining your business, or business risk indemnity, which is really contract risk. Commercial crime typically covers inside jobs by employees, and this is rarely covered on your commercial policy. So many times business owners find someone is stealing from them and there really is no recourse. So this will cover that. Cyber liability speaks for itself. Directors and officers, litigation defense, receivables, very much worth insuring. All it takes is a pretty good sized client to go bankrupt, leave your business hanging. It can be extremely painful, often result in layoffs, or maybe in some cases, a complete loss of business. It's also possible to insure losing key customers, losing key suppliers, or ensuring the entire supply chain, which is increasingly important in today's complex and tumultuous world. And that's probably an understatement. It also includes, we're also insuring, for example, in this case, reputation damage and special catastrophic risk, which is a business interruption catch-all policy. And you're not limited to these. This is just an example. But this business, by insuring all these things in the same 10-year period, has $10.7 million versus 5.9. So again, tale of two cities, the worst of times over here on the left, the best of times on the right. And the difference is choosing to protect the business with an insurance company known as a captive insurance company. So we're talking about what a captive insurance is. It creates, first of all, not only did it create more insurance, but it creates more money, right? What happens to assets in a captive that aren't paid out in claims or expenses? The owner keeps all of them. So captive insurance company benefits are everything on this page. Stronger business model, better risk management, better cost control, reaping insurance profits, asset protection. It's very difficult for a creditor to attach to your insurance company. This enables wealth accumulation and provided that the captive qualifies as a insurance company for federal income tax purposes and the business owner's tax advisor concurs. There's also favorable tax treatment that comes with being taxed as an insurance company versus being taxed as an operating company. All of this amounts to survival, right? Businesses that have this kind of protection have a far better likelihood of surviving the unexpected. So the benefits of a captive, and I alluded to this earlier, more insurance and more money, both. There's very few places in life where you don't have to give up something to get something. Captive is actually very unique because it creates an opportunity to, in a sense, have your cake and eat it too, having more insurance and more money. All right, let's pause right there for questions and see if we have any. You're welcome to unmute or type it in the chat bar. Very good. Okay, and we're recording this as well, so we'll be glad to send you the recording. So what is the significance of the 60-day countdown? Why do we do a 60-day countdown every year? Well, it takes time to form a captive insurance company properly. And if you stumble across an insurance company that's formed in a couple of days, you should certainly be suspect about that insurance company. So, the standard steps that we walk clients through if they're exploring owning their own insurance company to protect their business are as follows: a risk assessment, and then underwriting, and then a feasibility study with actuary pricing, captive formation by an attorney, submission of the business plan to a regulator that's going to grant the license, the licensing of the captive, then capitalizing the captive, paying premiums to the captive, policies being issued out. Of course, the last step being peace of mind, because now the business is far more protected than it was before. So, if you think about the significance of the countdown, we have a successful business and we've got profit to allocate, right? So you If you're an advisor or if you're a business owner, if you're an advisor, businesses that you're advising if they have a golden goose, hopefully it's laying golden eggs, right? It's creating profit. So what should the business owner do with these golden eggs? How would they allocate their golden eggs? Well, let's think about that. I mean, maybe capital expenditures, that's one way to allocate golden eggs. Dividends, owner profits, maybe benefits, maybe bonuses to key employees, right? Retirement plan, 401k. But really, what is the obvious, most logical way to allocate golden eggs? I mean, if you had a goose that was laying golden eggs, no doubt you would want to protect the goose, right? You'd at least allocate some of those eggs to protecting the goose each year, right? Every year, protecting the goose. And as I alluded to before, captive insurance works, and it works powerfully. And I'm going to encourage you, and I'm going to send, I'll have a link in the slides for this, but an article published where Captive International interviewed us, and they talked with Sean King, who's an attorney, CPA, and principal in our firm, and one of our founders, and then Jana Patel, who worked with us, and Jana and Sean co-authored this article, but they wrote about how many of our clients, and there's case studies in here, had their COVID claim paid, had their claim paid quickly, while businesses that were relying solely on commercial insurance did not have their claims paid. And so there's actually 4 cases covered in the article. That we had many more clients that had their COVID claims paid, by the way. In fact, we paid out almost $15 million across our captives in COVID claims. But one of them was a trucking company that had their city routes canceled. Well, that's a big deal, especially when, the trucks that are used for city routes are very different than long haul trucks. So you can't just turn those into long haul trucks. Many of them aren't tractor trailers, they're box trucks, right? So this is a big revenue hit. And while the PPP paid the employees, it didn't pay the loans on the trucks. It didn't pay the overhead of the warehouse. And so the captive really came to the rescue of this trucking company. Another example that was in the article, and I encourage you again to read this article, is an ophthalmology practice that was closed as non-essential. Well, it's very difficult when your business is paying your employees and paying your bills to be called non-essential, but it happened to a lot of small, mid-sized businesses. Pediatric dentistry practice suffered the same thing, closed as non-essential. And then we had an employee performance consulting company, and they do large training events, and their events were canceled. And this was they had to make a transition to more of an online atmosphere, but this was a huge revenue hit and a giant disruption. Their captive paid their claim quickly, which really helped them make the transition that a lot of their competitors weren't able to make. So that's a huge deal. And in the article notes, none of the CIC Services clients who had a COVID-19 loss went out of business during the pandemic. Huge. Think about that, when hundreds of thousands of businesses went out of business or were shuttered, not a single one lost. So you can read about that here or here, and I'll be glad to send you these slides at the end of the webinar today. All right, we've got one question. Let's see here in the chat bar. We'll go ahead and answer that. What about a large professional service firm that has professional liability, pollution liability, general liability, all in one form? Be glad to look at it. So we actually, if you go to our website, you'll see we launched a policy called EnviroCap, which is insuring pollution. It's fantastic coverage. And we have the ability with the carrier that's willing to partner with us to insure GL and pollution, and then run that, basically get rated insurance, but then reinsure a portion to a captive. Really exciting. Love to talk with you about that program and if it's a fit for your client. We've written professional liability. We've written professional liability, pollution, and general liability all in a captive. So love to look at that. If you can maybe send me an email after the webinar today, I'd love to look at that as a potential captive solution. All right, great question. All right, so who's a good candidate to own a captive insurance company? Well, really, if you think about it, we remember the golden goose analogy. If a business owner has a golden goose and it's laying golden eggs, right? then they often are a good candidate. So a successful middle market business owner that has something to lose. I mean, if you think about a startup business, they often run underinsured for good reason. They're barely making profit, right? And what is the strategy if the business gets in trouble? You got nothing to lose, quit, close, right? However, once a business is successful and is creating golden eggs, then a business actually has something to lose. I mean, the employees have something to lose if the business goes under. The business owner has something to lose, and whoever the business is serving has something to lose. So if a business has something to lose in the middle market, then a captive may be a really good fit for it. Now, what we find typically, these aren't hard and fast rules, but typically if the business has gross revenue of 3 million or more, they may in fact be a candidate to own their own insurance company, because that typically results in risks and justifies premiums that would cover the cost of an insurance company. So the question that we just got, for example, in the chat, of covering professional liability, general liability, pollution liability in a captive, that would be fantastic if the risk is large enough so that it generates sufficient premium so that the benefit of switching out of the commercial market is bigger than the cost to run the insurance company. So that's what we'd want to look at. For many of our clients, if they have $300,000 of golden eggs that they could allocate to protect the goose, then they almost always are a good captive candidate. So that's a really good rule of thumb. So captive insurance, remember the benefits are to protect the goose, right? More insurance and more money. Very few places in life where you don't give up something to get something. This is one of them. So if you're a trusted advisor, what might be in it for you? Well, certainly, deepening client loyalty. If you solve a problem for them, whether it's their commercial insurance costs are too high, they can't stand not having control over claims, they just got burned by COVID because they had a big loss, but they survived, and their commercial insurance didn't pay, and now they've got a solution going forward. Wow, what a huge win, right? So definitely deepening client loyalty. If you are an asset manager, sticky assets under management, and we also do revenue or fee sharing with advisors as well, because that is one of the ways that we market our services. So it's a win-win-win. That's really our goal as a captive manager. So anyway, having covered all that, what I would say, very similar to the American Express card, don't leave home without it. After the couple years we've been through, I'd say a captive insurance company, don't let your clients leave 2021 without one. All right, very good. That brings us to the end of our webinar today on the 60-day countdown. Its significance and ideal candidates to own their own insurance company. So here's my email, randy@CICServicesLLC.com. If you would like a copy of the slides I covered today, send me a note. I'll also be sending out this recorded webinar as well. And I'll take a minute or two for questions, see if we've got any. Feel free to unmute and ask your question, or you can type it in the chat bar. Okay, we've got a question. Can you spend a few minutes talking about capitalization of a new captive? Very good question. So yeah, I can give a very quick description of that. So when a business forms their own insurance company, normally it's going to get a license from someone. Many of our clients choose onshore domiciles. Domicile is I just think of it like a headquarters, if you will. So states license insurance companies and regulate insurance companies. Insurance companies are not regulated by the feds. So that's a real nice plus of the insurance space and of captive insurance. There are offshore domiciles that also license captives, but let's just focus on a U.S. state for now. So let's say that a state issues a license to an insurance company. That state will have looked at the business plan, the policies being issued, ideally reviewed the actuary work, and their goal is to make sure the captive is solvent. And obviously, when a captive is starting out, solvency can be more challenging, right? Because the captive is taking on risks of needing to pay claims. Now, typically that captive is going to be backstopped somehow, whether it's via reinsurance, whether it's via a reinsurance pooling arrangement, but most captives are not going to write insurance without some form of sharing. Even so, in the first year, typically, there's a need to get some capital into the insurance company. And so it really depends a lot on the risks being written, the number of risks, and the policy limits. I mean, are we writing, $500,000 policy limits, $1 million, $2 million? The higher the limits, the more capital needed. So typically, regulators will require at least 25% of first-year premiums, or typically $250,000 as capital into a captive, really whichever is less. So if you had, $500,000 of premiums the first year, the regulator might require another $125,000 in capital. A lot of regulators in the U.S. will let a business satisfy that with some amount of cash, and then often a letter of credit for the remainder. That letter of credit needs to remain in place until the captive has built up sufficient reserves over time. Typically that could be, 2 years, 3 years. When they've got enough reserves built up, hopefully they haven't had claims, because if they had a lot of claims, then the reserves wouldn't be there. But once reserves are sufficiently built up, the regulator will release that letter of credit. So that's a quick explanation on capital. If you're looking for something more specific, I'll be happy to jump on a call or answer it by email. Very good. We'll take like maybe another minute for questions. Outstanding. Well, it's been a pleasure to have you all with us today. If I can help you in any way, by all means, reach out to me. My email's here, and let's schedule a call. Have a fantastic rest of the week, and hopefully we'll be able to work together.